Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. 419-794-3030 is the phone number. It's 419-794-3030, online, arhq.com. If you missed the first half of the show, you just want to catch up on previous editions of the show or their topics, every episode, every show available via podcast on YouTube. Just search YouTube, America's Retirement Headquarters, Spotify, Apple Podcasts, wherever you consume your media. All the previous episodes there for you. Now, retirement is the shift from the accumulation phase to the withdrawal, the distribution phase. And when it's time to withdraw money for retirement, it can come from a variety of accounts. We might be pulling from taxable accounts, tax-deferred accounts, and tax-free accounts. Nolan, can you help clients decide which way they can boost their after-tax income the most?
Saving money in taxes is one of the passions that I have. I mean, anything we can do to keep the government away from your money, I think is extremely important. And, you know, at the same time, I would say as a veteran of the United States Marine Corps, I'm patriotic. I love America, but it is not your patriotic duty to pay more in taxes than what you're legally obligated to. But, you know, the challenge is navigating the environment can be very difficult. I know I just had somebody come in from the radio recently that we sat down and we talked about our tax savers checklist. And when we went through that, you know, what we had found is that he had probably a good CPA. And, you know, I'd also clarify in the fact that I'm not a CPA, I'm not an accountant. You should always seek the advice of your CPA or accountant before you make, you know, important tax decisions. But, you know, the conversation with him was a typical conversation. And that is, you know, once a year I get together with my accountant and they record history. You know, they fill out my filing of my federal and state tax returns, submit that information, and, you know, he sticks and puts it away until the following year. This individual happened to be a business owner. And so, you know, in a business owner situation, it becomes even more complex, especially when you have things like, you know, a limited liability corporation and, you know, how tax planning works. And what I explained to him is, you know, this is the time of year that you should be taking a look at, you know, what your withdrawal strategies are for not only this year, but also looking at next year. But you don't have to be a business owner to make taxes a top priority. Instead, what you want to do is think of your retirement account like a business owner and think about which accounts you should withdraw from first. I'll give you a couple of examples. I also met somebody earlier this year. We'll call him Mike. And when Mike came into the office, Mike was pretty excited to talk about the fact that he has not paid taxes since he retired. He retired a couple of years ago, and he turned on Social Security, and he started taking money from his personal savings account. So on the surface, I mean, I think we all want to high-five Mike in the fact that he's not paying any federal taxes right now. The challenge is what Mike didn't realize is that when you look at the amount that he gets in standard deductions between him and his wife, he actually missed out on several years that he could have pulled money out of his tax-deferred retirement account, and or he could have done a Roth conversion and paid either zero or very little in taxes, and by taking the money out. And what he did is he basically compounded his tax problem by spending down his taxable accounts, leaving the money in the tax-deferred category, not taking advantage of what the strategies are today, creates a bigger tax problem in the future. I also met with somebody recently, and, you know, in this particular situation, Linda a lot of her money. She's very of just her Social Security income and the amount of income that she gets from what is called required minimum distributions. Again, in her situation, when we did the tax analysis and we took a look at it, what we had found is that Linda has the ability where she could actually take more money out of her retirement account and or convert it to a Roth IRA and still pay zero to little taxes. You know, and her primary goal was any money that's left over is she wanted to leave it to her kids. Well, leaving that money in her traditional tax-deferred retirement account is not the most effective way to pass wealth on from non-spousal beneficiaries, in this case, her children. A Roth IRA could be much more tax favorable. A life insurance is a much more tax favorable. Even after tax money is much more tax favorable. So by Linda, she just didn't realize that she had the ability to take more money out. And another example is Bruce and Kathy. Bruce and Kathy came into the office and they talked to Scott here recently at one of our events and had talked about, how frustrated they were at their cost of their insurance for their health insurance had doubled recently. And by doing a little bit of an investigation, what we found out is that Bruce and Kathy wanted to pay off their mortgage right at retirement time. So when they retired, what they did is they took a big lump sum of money out of their 401k and they used that to pay off their mortgage. Now, again, the concept of being debt-free in retirement time, I think that's a great concept. I think you should, work towards being debt-free in retirement time. The problem is they didn't realize taking that money out of their 401k was going to be countable income, whether you're going for Medicare and what your Medicare premiums are, or whether you need health insurance pre-65 under the Affordable Health Care. All of that income can be taxable to you as well. So, not having the proper withdrawal strategy can be a very costly mistake for retirees. We've talked about inflation in previous segments on the show, and we've talked about how to make sure that your money gets up and goes to work every single day. It's not only so important to make sure that you're making every dollar work as hard as possible, but when you're looking at retirement accounts, you also want to look at how do you minimize other people like the government and taxes taking a chomp out of your money. And when you're looking at which accounts to withdraw from retirement, first, it can make a big, big difference. So one of the things that we can do is we can run a 2023 tax roadmap for you, or we can get your 2024 tax roadmap put in place for you. So if you're thinking about it and you're saying, hey, in my situation, nobody's really talked to me about which account I should pull from, my after-tax account, my tax-free Roth IRA, my life insurance account, my annuity, my tax-deferred IRA or 401k, that is a conversation I would love to have with you. In fact, I'd love to work hand in hand with your accountant or CPA, and or if you don't have one, I'd be more than happy to make a couple of referrals to make sure that you're minimizing the amount of taxes and you're having what could be the best withdrawal strategy for your retirement dollars in place. So again, just give me a call. We'll get a 2023-2024 tax roadmap put together for you, and we'll talk to you about which accounts you should withdraw from first.
The number is 419-794-30.